we are looking at this evening is accounting for non-accountants. Excuse me to take this in English because the presentation is prepared in English. So, accounting for non-accountants, making sense of numbers in business and life. Presented by Christina N. Nnewi, MBA, STI, IFR, FCA, on today being June 22nd, 2025. Why should non-accountants care about accounting? Accounting is not just for accountants. It is essential for decision making. What is accounting? In a simple way, accounting can be said to be a language of business. In a more broader way, it's a system for recording, analyzing and reporting financial transactions. Accounting records, it analyzes and reports financial transactions. Why should you understand accounting? Why you should understand accounting? Why? To make better financial decisions. You need to understand numbers for you to be able to make better financial decisions. You also need to understand accounting for you to detect fraud and errors. Some of you have businesses, some small businesses. No matter what your business is, you need to understand accounting a bit to be able to detect fraud and errors, especially when you have people managing businesses for you. If you have understanding of numbers, you'll be able to know when things are going wrong. Then you'll be able to make necessary corrections. To understand business performance, if you understand numbers, you'll be able to detect errors, you'll be able to understand how your business is going. To speak confidently with your accountant or your banker, if you are able to understand numbers, you can read your bank statement. Sometimes you might need to go to the bank and ask them to bring bank statement for you. If you understand numbers, you'll be able to read the bank statement and know when things are going wrong. So you know when to engage your bank. Key financial statements. There are 3 key financial statements that you need to understand. In accounting, we have 3 major key financial statements, and they are income statements or P&L. Then you have the balance sheet. You also have the cash flow statement. The income statement shows revenues and expenses. Income statement, I hope you are listening. Income statement shows revenues and expenses. It reviews net profit or loss. It answers the question, are we making money? This is the statement that answers the question, are we making money? So if you understand this statement, you'll be able to know if you are making money or not. Example, revenue. Assuming you have the revenue of say 5 million today. Let's say this month you made a revenue of 5 million in your business, and then you're able to total all your expenses, both direct and indirect expenses associated with the business, and all of them come up to 3.5 million. What is your net profit? 1.5 million. So if you are able to capture all your revenues together and capture all your expenses and remove your expenses from your revenue, you have a net profit. So this answers the question, we are making this amount as our profit. Balance sheet or statement of financial position. What is a balance sheet? A balance sheet is a snapshot of financial position at a glance. You see it. It's a snapshot. You just look at it and it tells you this is where we are standing at this particular time. So the balance sheet is a snapshot of financial position at a given time. It could be monthly, it could be half yearly, it could be yearly, but most of the time at the end of the month or your financial year, at the end of a financial year, a balance sheet comes out to say how the business is performing. So what is the component of a typical balance sheet? A typical balance sheet contains your assets, it contains your equity capital, and it contains your liabilities. If you have assets, let's say you are in business, you have people that are owing you, you have stock of things you are selling, you have, let's say, you have a building, you have equipment. All these are your assets. These assets put together is balanced out by another arm of the balance sheet. This other arm, that arm contains your equity capital and your liabilities. Those things you are owing, or those people you borrowed money from, or those goods they gave you on credit. If you add all those monies that represents these things you are owing, plus your equity capital is the capital you are using for business. If you add them together, they will be exactly the value of your asset. Are you getting it? It's important you understand this. Why we are treating this is for you to have some knowledge as a person that is not in accounting. So you'll be able to understand, even when a financial statement is prepared for you, you'll be able to read it. You'll be able to understand it. That's why we are taking this step to give this presentation here. So you have two arms of your balance sheet. You remember, your balance sheet is the one that tells how your business is doing. Your assets and you have your capital and liabilities on the other side. For example, if your total asset is 10 million and you have a total liability of 6 million, you have equity capital of 4 million, you see that this arm balances the other arm. That is how a typical balance sheet plays out. Then the cash flow statement. The cash flow statement is a track of movement of cash in and out of the business. The cash flow statement tracks movement of cash in and out of the business. It does not say that profit is equal to cash. The cash flow statement is not where they state the cash. No, it is just a statement that shows how cash has moved around the business. So, important accounting terms we need to know. Some important accounting terms we need to know are the following. Revenue. I hope you know what revenue is. Your income. You need to know about expenses, the things you are spending. Assets, what you have, whether they are fixed assets, non-current assets, or they are current assets. Your cash in the bank, the money that people are owing you, the stock you have in your shop or your warehouse. These are all assets, including your building, your motor vehicle, your equipment. All are assets. You need to know, understand this. Your liabilities, the people that you are owing, or whether they are long-term or short-term, these are your liabilities. And you need to know your equity capital. Equity is that capital you are using for business. You know it. If it's a registered business like a limited liability company, maybe your equity capital is 1 million ordinary shares, or 5 million, or whatever million. That is your equity capital. Depreciation is the apportionment of a fraction of your non-current assets over time through the income statement, possibly for replacement. Then accrual versus cash basis. Accrual versus cash basis is about the point at which revenue or expenses is recognized in the account. Financial transactions can be kept in accrual basis or on cash basis. But most of the time, accrual basis that we use, most businesses, because the accrual basis gives you a better view of what happened. Because it recognizes revenue and expenses at the time it was incurred, not necessarily the time it was paid. Cash basis means that you recognize revenue or expenses at the time you paid cash. That's at the time you exchange cash. But it does not give you the true picture. It does not tell you about what you are owing or what you are being owed. So accrual basis is the basis of most accounting records, especially financial statements preparations. You prepare. If at the end of the year, maybe you have raised an invoice of 10 million, you have submitted to your clients, but they have not paid you. You did a job, they haven't paid you. Your revenue will be recognized. That 10 million will be recognized in your revenue, even though you have not been paid. Eventually, you are paid in January. When you are paid in January, it is just cash that you receive, but revenue, you earn it in December. So that is how we record financial transactions, because it is the one that gives us the full view of how the business has performed. Cash basis may not give you everything. Accounting in daily business, you need to understand some of these terms. What are the accounting that is involved in your daily business? You have something like pricing of your products. It's accounting. Pricing of your product or your service. You have to sit down and know how to price what you are doing. Then have budgeting. When you make a budget of a project, what you are going to do, you put it in writing. Say, I'm going to do this, do that, I'm going to do that. It becomes a guide on what should be done at a particular time. That's your budget. Or forecast. You forecast a project. This is how it's going to be, and then you work towards it. Then loan applications. Sometimes we need loans. You go through loan applications. Then tax compliance. There is a necessity of knowing how to comply, how to be tax compliant. Some people, especially small businesses, they don't take these things serious, but it is important that you are tax compliant. Find out what taxes are important for you to pay, and then try to comply on time to avoid penalties. In payroll and staff costs, of course, if you are in business, you will likely pay staff, and then staff costs. There are regular payroll costs, then staff costs, other costs, maybe like medical or some other things that are expenses you incur on your staff. You know all these are all items of accounting. So you need to understand these things. These are things that are accounting on daily basis that you go through or that is necessary for your business to thrive. Common mistakes non-accountants make. Some of the common mistakes that non-accountants make are as follows, like mixing personal business funds. Most of us do it. We don't separate our business from us. Even if it's a business name, there's still a way you can consciously separate your own money from the business money, especially when you have a business account and then your own personal money goes into your account, so that if the business pays you, you can't take that money to your personal account. It becomes what the business has paid you. So some of the mistakes they make is not keeping records. Some of the business owners, especially small business owners, find it difficult to keep records. And some of the reason why, it's part of the reason why we are discussing this today, to see whether you have a better understanding to be able to keep record of what you are doing, even at that small level. Okay. Ignoring taxes. Most small businesses ignore taxes, but we can do better to find out what taxes we are required to pay, and then pay it at the right time. Focusing on sales and not profits. We need to focus on making sales and also find out if we are making profits. Cash management, we need to manage our cash properly, find a way of managing cash better. Basic tools you can use. If you have a personal computer like I have now, you can explore using Excel. It's a spreadsheet to track your expenses. You have a small business, but on your own, if you had a computer, you can try and learn how to use Excel so that you can track your expenses and your income just with the spreadsheet. If you are tracking it on a daily basis, you'll find out that it will be easy for you to sum it up. Sum this up at every point in time and know where you are standing. So these are some of the tools you can use. Use spreadsheets, Excel spreadsheets, Then there are accounting packages that are for small businesses like QuickBooks, like Peachtree, like Sage. Like there are not so many accounting packages, but these are a few little ones that I'm just mentioning. These ones, if your business is a little bit big, you can deploy them. If you deploy them, the package will help you to keep overall account. So at every point in time, you can draw out a report out of the package, and you will know how your business is doing. Then, mobile banking app. These are some of the tools. Now, mobile banking apps, you know, this era we are in now, this is one of the benefits of this time. Because we now have banking apps, it is easy for you to track your transactions through your app if you give proper descriptions. So I'm bringing it to us to understand that that app you have is a tool for keeping accounts, but you may not know, but now you know. So what you will do is that anytime you are issuing transfer narration, you make sure you make it, put something, that word that will help you remember what you made this transaction for. It will be there, and if the bank is such that allows that narration to enter, you find out that anytime you bring your bank statement, you'll be able to even analyze everything without saying, what did I use this money for? It will be so easy. So use your mobile banking app as a tool for accounting. Then hire a professional accountant or bookkeeper. There are businesses that have grown to certain level that you may not be able to manage everything. You need a professional at that time. Or if your business is still very small, you can hire a bookkeeper. Bookkeeper is someone that knows how to make accounting entries, like an HND holder, or sometimes a PSC holder or HND holder. They can work as accountant in the department and help you to keep records of what your business is doing. Then at some level, if you understand that things are becoming overwhelming, then speak to a professional, hire a professional. Taxation basics for entrepreneurs. Understand your tax obligations. Some of the tax obligations we have is VAT, value added tax. That is consumption taxes that are appended to most transactions. Sometimes when you don't know because they are inbuilt into what you have transacted. CIT, company income tax. So business it depends on where you're based. Not every business pay tax. With the changes in tax laws these days, some businesses are quite exempt. If your business had not reached, your turnover had not reached a certain level, you may not be required to pay CIT. But once you got to a certain level, you ought to pay CIT. Then personal income tax. This personal income tax we talk about pay as you earn, and some other taxes that personal income tax that are paid by business owners that are not necessarily paid. Then keep accurate records. Basics, keep accurate records. File returns on time. Get professional advice when needed. Take away. You don't need to be an accountant, but you must understand your numbers. Financial literacy is supports business success. Partner with professionals, but stay informed. Final words. Numbers tell a story. Make sure you understand the story your business is telling. Thank you. Nnewi, MBA, ACTI, SAT, IFR, FCA, Chartered Accountant, Business Advisor, Tax Practitioner of the firm of Nnewi Chartered Accountants.